hit the button, so now it's recording.
Hello. As part of the UMaine MBA program, we've created a hedged portfolio. Next slide. This portfolio was created by the Cash Cows, aka Group 8, and it comprised of 4 UMaine business students. The first student was Selena Cunningham.
Hi.
And then I'm Kevin Jankowski. And there was Charles Riccardi.
I'm Charles Riccardi, sorry.
And I'm Abdikadar Shaya.
So our portfolio approach was really focusing on creating a diversified portfolio utilizing ETFs. The ETFs were multiple types of assets. They were diversified across being stocks, currencies, and bonds. And we also diversified in the different industries, which included healthcare and technology. Another aspect of diversification that we focused on was the size of the company, whether it was small, mid, or large cap. And we even broke it down to who was managing the funds. Another aspect of diversification also was the location, whether they were US or international. Besides choosing a diversified fund, we also wanted to make sure that we were selecting assets that were in very strong and stable industries, and keeping the expense ratios of those assets very low. Another aspect focused on was trying to reduce our bias as best as possible, because we didn't want to choose only companies that we knew, but companies that were actually performing well. Next slide. So the overall project was using $100,000 as our total investment, which we invested starting on January 26th. We decided to do an equal split of about $50,000 between our long positions and our short positions. Overall, below is an image of our assets, and you can see majority of this was chosen within the healthcare and technology sector. The portfolio was run with a closing date of February 25th, 2024. Next slide. The first pair of assets was healthcare. The long position was the Healthcare Select Sector SPDR fund with the ticker symbols XLV. This asset had a beta of 0.68, which has a relatively low risk. It also had a very low expense ratio of 0.10. This fund typically invested in pharmaceuticals and healthcare. On the short side, we really focused on choosing an asset that had similar correlation. The correlation was up 0.74, and it also had a relatively low expense ratio of 0.45. The XLV performance resulted in positive $844, and IBB performance was, I believe it was negative dollars. Sorry, it's cut on my screen.
Negative 281.16.
All right, thank you. Next slide. On the US large cap assets, we diversified using Schwab. We used Schwab US large cap. It had a beta of 1 and an expense ratio of 0.3. This kind of focused on the top performing stocks across the technology sector. Microsoft, Apple, and NVIDIA were the top 3 holdings. In the short position, we chose the ticker PTLC, and that was also a large blend of the US S&P 500 companies. The correlation between these was very close to 1, so they pretty much mimicked each other. And the Schwab Fund was a positive $270 performance, and the PTLC was negative 219 approximately. Next slide.
For our currency assets, we focused on Bitcoin-related ETFs for both. We took a long position in the ticker WGMI, that invest in companies that derive income from Bitcoin mining operations, but the ETF doesn't invest in Bitcoin itself, and went short with the ticker BITS. Both betas at the start of our portfolio were 0.00 because they're both relatively new ETFs, which we then learned as the project went on, and recalculated those numbers. Bitcoin performed well over the last month, so our long position was up $563, and our short went up, so we've lost money to the tune of a little over $1,100. Next slide. And for our bond assets, we went long on US an ETF TLT that invests in US Treasury bonds with remaining maturities greater than 20 years, and decided to short IAGG, which gives exposure to emerging markets outside the US. So we kind of were betting on the US market compared to international market, and more or less the bonds didn't change much over our month. TLT went up $5, and IAGG, we lost $16.
Within the real estate portfolio, we longed the IYR real estate ETF, and this had a beta of 1.11, an expense ratio of 0.40, and this included investments in real estate companies and REITs. And then on the short position, we had a FTSM ETF, and this had a beta of 0.04, an expense ratio of 0.50. And overall, this the performance of the IYR was negative $3.60, and the FTSM was $10.50. So relatively modest performance in this portion of the portfolio. Next slide, please. On the technology side, the long position, we took an OGIG, which has investments in technology, communications, and major technology companies that we're very familiar with. This included a beta of 1.110 and an expense ratio of 0.48. And we shorted the IRBO, which is iShares Robotics and Artificial Intelligence EFT ETF, and that included a overall beta of 1.25 and an expense ratio of 0.47. The performance included $164 on the OGIG and negative $126 on the IRBO.
On the US small cap assets, we selected long for Vanguard S&P Small Cap 600 Index ETF with the ticker VIOO. The initial price was 97 and a total investment of 9,215. The beta was 101 with a weighted beta of 0.186 and expense ratio of 0.1. The fund was made up of top 10 holdings, and the top 10 holdings of the fund was made up of 11.18%. And among them was the Fabrinet, FN, CYTK, and many others. On the short, we selected Vanguard Small Cap Index VB, the initial price of 210 with a beta of 1.04 and a weighted beta of 0.199 and expense ratio of 1.04. This was a blend of large US S&P 500 companies. The top 10 holdings were made share of 3.77% of the total fund. Among them was the SoBi Microcomputer, Wheelers FirstSource, and BTC Incorporated. The correlation factor for the two funds was 0.98. VIO performed with a positive 54.15. VB, we realized a negative 265.27.
So this shows the performance of our entire portfolio, all our assets over the month. Our long positions gained a little over $1,900, but unfortunately our shorts also went up, and so that we took a $2,000 loss with those, the majority of which was in the Bitcoin ETF BITS. That netted out to a $65 loss, which is roughly 0.13%. But once we factored in trading fees and no taxes in our case because we had a net loss, but with the fees factored in, we took a $345.37 loss on our portfolio. Next slide. And then once we factored in ETF expense fees, that equates to a $369.29 loss, which is 0.37% of our initial investment. We did pretty well in our 14 assets that we purchased in the month. We hit with 5 long positions and no shorts, which equates out to a 35% batting average. Next slide.
So overall, as Charles explained, our portfolio saw a little bit of a loss. We, in hindsight, I think learned quite a bit through this experience. The first thing we would do if we were to do it again was to include commodities, which was included in the syllabus. We didn't include it in our overall portfolio. Also, we learned quite a bit around analyzing the beta, looking at fully accounting for all assets, including newer assets, as was mentioned previously, the beta of the initial Bitcoin holdings was not, I think, articulated accurately in our analysis. So we revised that and updated that to include, recalculated that. Also, taking a look at the expense ratio, overall was 0.565, higher than ideal, although not super high, but an area where we could have, I think, seen a little bit more savings. And through our analysis, we identified an area that we could improve on in the future relating to trading fees and ETF expenses that really impacted our overall performance when we looked at that more holistically. And taking a look at the full picture of the full analysis helped us understand the amount of loss overall. And then in terms of market segmentation, I think we had fairly good representation in both healthcare and technology. We could have expanded that beyond to include sectors of the economy that are not part of our daily lives, but may also be really important in terms of economic growth. And of course, we are influenced by our biases. For the first one is related to the role of graphs and information that's presented. And this comes into play both in terms of the fees associated with the various holdings, but also in terms of anchoring heuristic and understanding that the most recent activity may affect how we think about the overall or projected activity of the holding. Also, in terms of confirmation bias, that is a part of this, as well as availability heuristic, where we're most likely to invest in the types of holdings that we're familiar with. And so through this, we certainly learned that there is no free lunch, and there is a way that we need to analyze all the data that's available to make sure that we are maximize all of our investments to the extent that we possibly can. Next slide, please. So the project highlighted the complexities involved in identifying long and short positions of a market neutral portfolio. And this included pairings in the healthcare, technology, Bitcoin, biotech, and real estate, and AI. And in total, the portfolio performed negatively with a loss of $65.37, with a net exposure of $3.29. There are a variety of correlations with pairings ranging from 0.12 to 0.99. And since developing the portfolio, our knowledge has certainly increased substantially, and we had benefited from not only the collaboration in our group, but also the learning from the professor and the rest of the classmates in the lectures throughout the class. So thank you very much.